There are two schools of thought in this economy: the optimists who see a sustained rally, and the realists who view it through the lens of reflexivity. Right now, a significant tech and chip stock rally is underway, one that is perfectly testing George Soros' theory. The rally is not being driven by a change in economic reality, but by a sudden shift in liquidity expectations, a classic example of the market's perception, the manipulative function, influencing the fundamental policy, which is the cognitive function. The Federal Reserve is the central object of analysis. Markets are betting on the failure of the Fed's restrictive policy to curb the economy. This rush to buy equity is a direct consequence of the market's belief in policy easing. Markets are currently betting on a swift policy reversal from the Fed, pushing rate cut expectations far higher than current economic data justifies. I'm not going to show you a chart. I'm going to give you a math problem that reveals the gap between belief and economic reality. Ask yourself, based on the historical relationship between unemployment and monetary policy, what level of job losses would statistically need to occur to justify the market's swift confidence in immediate policy easing? Comment your guess. The number reveals the extent to which expectation has outrun economic data. We have been here before. This is the heart of the Soros-Fed dynamic. George Soros' fame is built on the fact that he understood that a central bank cannot fight a flawed policy promise. If you remember Black Wednesday in 1992, Soros bet $10 billion against the Bank of England, proving that the market's conviction, which is the reflexive belief, could force the system to break its own promise. However, the current rally provides a critical advantage. This surge is boosting equity valuations in your 401k and IRA accounts, simplifying tax loss harvesting, and maximizing your retirement portfolio value right before the next statement cycle. It also stabilizes the cost of variable debt like mortgages. So I have to ask the question that splits this country in half. Is this reflexive surge a dangerous bubble that you must sell immediately, or is it a necessary opportunity to maximize your savings and lock in better debt costs before the new economic year begins? Your answer determines the future of monetary policy. And right now, the greatest wealth transfer is happening silently. There are two schools of thought in this economy: